All right, let's talk about how you can retire and how you can plan for retirement. It's important to understand the math behind getting to where you are today to where you're going to be in retirement and what you need to do to bridge that gap. So we're going to be talking about a couple of things. Firstly, we're going to be discussing the income that you're going to need in retirement and the assets that you're going to need in retirement to achieve that income. We're going to be talking about inflation. We're also going to be talking about the returns you can expect to achieve up until retirement and the returns you'll probably expect during retirement. All right, so when you're considering retiring, the first thing that you want to come to the conclusion of is how much money you're going to need in retirement and when you plan to retire. The earlier that you choose to retire, the more aggressive that you're going to need to save. And also, of course, the more income that you need in retirement, the more you're going to have to save and the more aggressively you're going to have to save and invest. All right, so once you have an understanding of how much money you're going to need in retirement on an annualized basis and roughly when you're planning on retiring, you can start the math to back into how much you'll need to save today to get to where you will need to be in retirement. Firstly, you need to adjust whatever income you need in retirement to the future value of that money. For example, $100,000 today is actually going to be more like $200,000+ in 30 years. The reason being is because of inflation. As time goes on, the value of our dollar decreases, meaning that if you want to have the same lifestyle that you have today, you'll actually be spending more money in the future. So the first calculation that you're going to need to do is determine how much your money is going to be worth in the future, depending on when you're going to retire. I am going to retire in roughly 35 years. So the calculation that I would do is take the amount of money that I would like in retirement, say $100,000 a year, and compound that at 2.5% for the next 35 years. Compound interest is actually a relatively complicated formula. So rather than trying to do the math associated with compound interest, I recommend simply pulling up a compound interest calculator online. That said, in my particular circumstance, $100,000 today will be $237,000 in 35 years. That's $100,000 compounded at 2.5% for the next 35 years, roughly $237,000. So I actually need to plan on having $237,000 of annual income in retirement to replace the income that I am generating today and having the lifestyle that I have today. And that brings us to our next calculation. We now need to determine how much in total capital you will need to generate, in my case, $237,000 of annual income from my investment savings. A good rule of thumb is a 4% annualized return in retirement, or expected return of 4%. The reason being is this is a conservative enough return that your assets can be in non-market correlated investments in which you won't see any volatility. They're generally in pretty low risk assets where you won't see losses, so you won't have to worry about potentially losing money in retirement. And if you choose, you can allocate your resources into slightly more aggressive investments to achieve returns that will adjust your retirement savings for inflation, because that 2.5% of inflation will continue during retirement. If you can withdraw 4% plus generate a couple of extra points for inflation, you're off to a really good start during your retirement period. So the rule of thumb is 4% of the total capital in retirement. As such, 100% divided by 4% is 25. So you will want to multiply the amount that you need in retirement every year, in my case, $237,000 times 25. In my case, that is $5,925,000, so just shy of $6 million. So I will need nearly $6 million in retirement to achieve the equivalent of $100,000 of income in today's money. So first and foremost, we have to come up with a rate of return that we can expect over that 35-year period. We want to be realistic, but also conservative with our return estimates. I generally recommend a 9% rate of return assumed for your long-term financial planning. This is in line with what we've seen in the market over the last several years, but is slightly conservative. The reason I choose to be conservative with these estimates is because we just don't know. Making a guess as to what the future returns of the market will be is difficult at best. And in reality, we might see returns substantially below or above what we've seen over the last 20, 30 years. And so assuming that we're going to see higher returns or the same returns, in my opinion, is a bit of a fool's errand. And so I recommend being conservative with our estimates. 9% isn't overly conservative, but is a realistic number. And to give some context to that number, the stock market has done about 10 to 11% over the last 30 years, depending on what exact stretch you look at. So 9% is right in line with those returns without being overly conservative. If you're a little bit closer to retirement and therefore can't be in as volatile of assets, you might want to consider this calculation at more of a 7 or 8% rate to adjust your portfolio down to be less concentrated in volatile or risky assets like stocks. Now that we have a total amount of capital that we would like to have in retirement and a return that we can expect over that period, I would now recommend pulling up a savings goal calculator. There's actually one on the investor.gov site that I recommend using. It will allow you to put in the total amount that you need in retirement, the rate that you expect over the period of time in which you're saving, and the amount that you would like to save each month. You can actually even put in the amount that you have saved thus far to make the determination. I'm going to use the example of myself. We're going to assume that I have no assets saved up thus far. In my particular case, to get to where I need to be in retirement in the next 35 years, I would need to be saving a little over $2,000 a month to achieve the $5.9 million of total capital required to achieve the income that I need in retirement. So you can see just how important savings is. With inflation, it's critical that you save large portions of your income to get to where you need to be in retirement. Obviously, there's some important adjustments that can be made. My particular situation might not be yours. You might not feel as though you need as much income in retirement. You might feel that you need more income in retirement. You might also have assets in a 401k in which are being matched by your employer. So you can actually put in less money each month because your employer is matching a portion of what you're putting in to increase the total amount that is being saved. As always, hopefully this provides some context into your particular financial planning. Hopefully it gives you some math to work with to plan around your financial future. As of course, I always say, this is not financial advice. This is simply an opinion, information for me to share. Always do your research before making investments. Always consult with a licensed financial advisor before actually making any determinations with your capital. But hopefully this gives you some context as some math that you could be using in your long-term financial planning. Thanks so much. Comment below with any questions and don't forget to subscribe. Bye-bye.